For years, investors were told they were putting their money into real estate, a massive real estate empire, a portfolio allegedly worth hundreds of millions of dollars. And for some investors, the money came from their retirement savings. But according to federal authorities, millions of dollars were diverted into speculative trading, personal expenses, commissions, and payments to earlier investors. The company had raised more than $50 million. Hundreds of people had invested. And the real estate empire they thought was protecting their money, federal prosecutors said it did not exist in the way they had been led to believe. This is the story of Wells Real Estate Investment. To understand how it happened, we need to go back to before any of this had a name. This case involved roughly 660 investors, according to the SEC. To tell it as one story, we're following a representative investor we'll call Diane. She isn't a specific person named in court records. She stands in for the retirees and near retirees described in the government's filings. And everything you're about to hear happened to real people in this case. Diane was in her early 60s, a handful of years from retiring, and doing what a lot of people her age do at that stage. Looking for somewhere to put her savings that felt sturdier than the stock market, but paid more than a bank account. Real estate had always seemed like the safe choice to her. Buildings don't disappear. Land doesn't crash the way a portfolio of stocks can crash. So, when she came across a company called Wells Real Estate Investment, it made sense to her almost immediately. The pitch was straightforward. She would buy a promissory note. Wells would use the money to buy and improve property. Her note would be backed by that real estate. And in exchange, she'd earn a return that put her retirement accounts to shame. Something like 12% a year on the shorter notes, and, on the longest ones, a payout that could nearly double her money by the time the note matured. What made the company convincing wasn't just the return. It was the size of what it claimed to already own. Wells said it controlled a real estate portfolio worth as much as $450 million. Diane wasn't lending money to a stranger with a plan. She was investing in a company that already appeared to sit on an empire of property. If the assets were really there, the risk felt small. She put in a portion of her retirement savings. Not everything she was cautious about that much, at least at the start. But caution doesn't help much when the numbers you're checking have already been built to survive a glance. Here's the part worth slowing down on, because it's the actual engine of this case. What made this work wasn't a slick salesman or a fake office. It was scale. A single unverified promise is easy to be suspicious of. A $450 million real estate portfolio is not something most people can check on their own, so it does something quieter. Instead, it borrows credibility from the idea of real estate itself. Something you can picture. Something that feels physical and permanent, even when nobody's actually walked the properties. Diane wasn't being asked to trust two people running a company out of Boca Raton. She was being asked to trust a number. And numbers, unlike people, don't hesitate or slip up in conversation. Court records tell a more specific story about who was actually behind that number. Wells Real Estate Investment was formed around 2017 by Janalee Camille Bingham and her husband, Gene Joseph, also known as John. Bingham was listed publicly as the company's CEO. Joseph wasn't listed at all. He'd already been convicted in a separate wire fraud case, and prosecutors say he and Bingham worked to keep his name off the business once that conviction happened. In October 2019, the two of them opened a bank account for the company with Bingham as the only person authorized to sign officially because of Joseph's pending case. According to prosecutors, Joseph kept directing transactions through that account anyway, including after he went to prison in 2020. So while Diane and hundreds of other investors believed they were dealing with a legitimate real estate company run by its CEO, a man with a fraud conviction was reportedly still steering things from behind bars. Of the more than $50 million raised, only a small fraction went toward actually buying real estate. Investigators say roughly $28 million was instead funneled into speculative trading options, futures, high-risk equity positions, spread across dozens of brokerage accounts. The money that was supposed to be buying buildings was instead riding on bets in the financial markets. There was also the matter of commissions. Investors had been told Wells didn't pay anyone to sell its notes, that the whole return was going toward their investment, not toward sales. In reality, the company was paying commissions as high as 15%, distributing roughly $8 million to the people bringing in new investors. That's not a small detail. It meant the sales force had every reason to keep the pipeline of new money flowing, regardless of what was actually happening with anyone's real estate. And that flow of new money mattered because it was propping up the old money. Prosecutors say more than $8 million in investor funds was used to pay earlier investors, the classic move of paying old debts with new deposits. Diane's early payments came in on schedule. That was enough to make her feel confident. It's also, according to the government, exactly what those payments were designed to do. Some of the money went somewhere much simpler, a $1.95 million house. Prosecutors say Bingham and Joseph used investor funds for a down payment on the property, bought it through an LLC, and then quietly transferred it into Bingham's name, where it became their primary residence. By 2024, the pattern had run for years, pulling in more than $50 million from investors across the country. In August of that year, the SEC filed an emergency action against the company and both defendants, freezing what assets remained. A federal receiver was appointed months later to try to untangle what was left of the business and figure out what, if anything, could be returned to investors. For Diane, that's the point where the story stopped being about a retirement plan and started being about a legal case. The statements she'd been checking no longer meant what she thought they meant. Both Joseph and Bingham eventually pleaded guilty. Bingham admitted to wire fraud. Joseph admitted to conspiracy to commit money laundering. U.S. Attorney Jason Reding Quinones, announcing the case, said plainly that the defendants had sold investors a $450 million real estate portfolio that never actually existed the way it had been described. Both were sentenced by U.S. District Judge Jose E. Martinez Bingham to 4 years, Joseph to 20. A few things about this case are worth carrying with you. The first is that a big claim isn't proof of anything. A company that says it already owns hundreds of millions of dollars in property sounds safer than one making smaller promises. But that size is exactly what makes the claim harder to verify and easier to fake. The second is that a payment landing on time doesn't mean an investment is working. In this case, it sometimes meant the opposite, that new investors were quietly funding old ones. The third is that a promise not to pay commissions can be part of the pitch itself. It's meant to signal that the company isn't incentivized to oversell you. Here, that promise was false, and the incentive to keep selling was very real. If you're weighing an investment like this, especially with retirement money, a few things are worth doing before you sign anything. Ask for records of the actual assets a company claims to own, deeds, titles, something a third party can verify, not just a summary sheet. Check whether the people running the company have a regulatory or criminal history. In this case, that history existed and was actively being hidden. Be wary of any advice to move retirement funds into something new, and if a return looks meaningfully better than what comparable well-established investments are paying, treat that gap as a question that needs answering, not a reason to move faster. Diane didn't lose her retirement savings because she was careless. She lost them because a fabricated real estate empire, backed by a steady stream of well-timed payments, looked exactly like the safe, boring investment she'd gone looking for. That's worth remembering, because the people who build schemes like this one aren't preying on gullibility. They're preying on the same patience and good judgment that usually keeps people safe, which is exactly what makes a well-constructed lie so hard to spot from where you're sitting.